Hey guys, thanks for joining me today. My name is Jason Fieber, and I, of course, write the Undervalued Dividend Growth Stock of the Week articles for Daily Trade Alert. I'm also the founder of Dividend Mantra and the founder and publisher of Mr. Freed 33. And this is part of a new series of videos we're doing for you readers. We're trying to, me and the guys over at Daily Trade Alert, we collaborate a lot on new ideas, and we try to come up with new ideas that we think will help you readers and help provide more actionable ideas and help inspire and motivate and provide more value, and so that's what the series is all about. So what this series is going to do, what I'm talking about today, is one of the Undervalued Dividend Growth Stock of the Week articles I recently wrote. And you can see my screen here. We're going to do like a little screen sharing exercise here to kind of show you what we're doing. And so when you're over at Daily Trade Alert, if you go over to the Dividend Growth Investing tab and pull up Undervalued Dividend Growth Stock of the Week, it'll show you all my Undervalued Dividend Growth Stock of the Week articles that I've been writing since, late 2014. So we're talking more than 100 articles here. And what we're doing is, what I'm going to do is I'm going to do a video on one of the articles. And just for some background here, at the bottom of the article I'm going to go over, which is for Magna International, at the bottom of that article, you'll see a little reference video here, kind of talking about the series and what we're going to go over and everything. What I'm going to do is I'm going to pick an Undervalued Dividend Growth Stock of the Week from each month. So usually, 4 to 5 articles per month. I'm going to pick one of those articles. So for instance, for May, I wrote about Amgen, Qualcomm, Magna International, and I also wrote about Discover Financial, which isn't in the list quite yet. Once it gets archived, it'll be in here. But each month, so for May, I'm looking at one of these articles, and I'm going to pick one of the stocks, and I'm going to do a video on that stock and that article, kind of showing where I came up with everything, showing where the conclusion came from. And again, that way it adds value for you readers. So when we look at Magna International, I'm going to go over everything. I've got a number of different tabs pulled up for Magna International, so you can kind of see where I came up with everything. And just kind of for some quick background on these articles, what we're trying to do with these articles, or what I think about when I write them. I'm trying to provide motivation and inspiration and then information as well for you readers. So, I believe in dividend growth investing because it quite literally saved my life. I was, as I talk about in the articles, I was worth, less than zero. I had a negative net worth back in late 2009, early 2010. And I started saving money, and I started investing that money, the savings that I was generating. I started investing that capital into high quality dividend growth stocks. And through that process, I've built up a very large portfolio that generates, 5-figure dividend income for me, real income, real money that I don't have to go to work for. And that passive income covers a significant chunk of my expenses, which are low because I've been living frugally all this time to save the money and invest it and so on and so forth. So, it's all circular. It all, works together. It's all, part of a holistic approach to living and saving and investing and everything else. So, nonetheless, I go over every article. I talk a little bit about why, you should even be interested. What's the buy-in? Why even be interested in dividend growth stocks? Keeping in mind that I'm not selling anything here. I'm trying to provide information for you readers. I'm not I'm not selling some ebook or something in these articles. I'm not trying to link you over to some subscription or something. I'm just providing information for you guys. So I talk a little bit about why dividend growth investing is valuable, and I also get into the valuation process, which of course is important, and I talk a little bit about that in the evergreen video, the reference video that, again, you can pull up at the bottom of Magna's article here. This little link will take you to the video where I talk about, these articles kind of from a high level, how I approach these articles, what I'm thinking about when I look at value and everything else. But, when you value stocks, it's just like valuing anything else in life, guys. I mean, if you were to go to the grocery store and, a loaf of bread were $10, you'd say, that loaf of bread that's too expensive. I mean, does it have, 24 karat gold flakes in it or something? I know, there's cinnamon raisin bread, and there's a, brioche, and there's some fancy breads out there, but $10 a loaf, we're talking, it must have gold in it or something, whereas if you see a loaf of bread that's 50 cents, you're going to think it's, 3-day-old bread or something. So, it's intuitive to always value things that you're buying. You look at a price and you say, is this price appropriate or not? Well, same thing with stocks. You don't want to overpay for stocks. You don't want to pay $10 for a loaf of bread. Well, you don't want to pay $50 for a stock worth 30, because it's a terrible use of capital. And if you keep doing that over and over again, you're going to lose a lot of money, or you're going to be far behind the eight ball, far behind where you should be. If I were to constantly go over and buy stocks that are way too expensive, and pay too much, then, at the end of the road, I have less income, less wealth, and I'm further behind my own goals. But because I try to always look at valuation, through a prudent lens, I've been able to, increase my yield, because as I talk about in the articles, price and yield are inversely correlated. So when you buy an undervalued stock, if the price is lower due to undervaluation, the yield should be higher. Price and yield are inversely correlated, so all else equal, a lower price will equal a higher yield. And that affects your income, that affects your dividend reinvestment, that affects your compounding, that affects your current income, long-term income, that also affects your total return, because total return is made up of capital gain and then your income side, which is, through dividends or distributions. So that affects that side, and then the capital gain is also given a potential boost via the upside that exists between, the undervaluation and the price. So that gap, if it closes, which it should over time, that gap results in extra capital gain above and beyond what the stock would have provided over the course of doing business normally. And then, of course, you want to try to reduce your risk as well by introducing a margin of safety. So what we're going to do is we're going to talk a little bit about Magna today. I've got the article pulled up. Again, I showed you where to pull that up. And with each article, I talk about what the company is, what they do, a little bit about the business model, and then I get into some of the dividend information. And talking about Magna, as I wrote out for you guys here, this information here, this little paragraph about what Magna is and what it does, you can find that in the annual reports, and I've pulled up 2 annual reports so you can follow along. But every company will obviously tell investors what it is, what it does, how it makes money, and I try to stick with businesses that have a business model that's fairly easy to understand, and I think Magna qualifies. I mean, they're basically manufacturing a number of components for vehicles. And if you think about a car, you think about, body panels and pulleys and, electromechanical parts and valves and, all kinds of stuff. And, I worked in the auto industry for a long time, so perhaps I have a little bit more, of maybe intuitive mindset when it comes to cars. I'm fairly aware of how they're made up and what makes them go. For somebody else, maybe Magna wouldn't qualify, and that's okay. Not every stock I write about is going to be a good investment for everybody. I just try to provide, what I think are solid long-term ideas. Good dividend growth stocks, high-quality dividend growth stocks, and at prices I think are good values at the time of the publication of the article. So, but Magna, I think, offers a pretty easy to understand business model. You're talking about, a number of, Magna is the most diversified automotive supplier in the world, such that they could almost manufacture a car by themselves. They could almost make a Magna car if they wanted, because they basically make everything for a car. But what they do is they're basically a third-party supplier. So they work with OEMs, which are original equipment manufacturers. Think BMW, think General Motors, think Ford, think Tesla. These companies actually manufacture cars, but they outsource a number of those components to outside companies such as Magna, and Magna and companies like that actually manufacture the components so that they can go on these cars. Okay, and auto manufacturers, I've never invested in an auto manufacturer. I've never invested in Ford or General Motors or any of those companies, because the automotive business is very cyclical. I mean, one of the reasons I was actually below broke or had a negative net worth back in 2009, well, a lot of it was due to my own spending problems, personal responsibility. But I was actually let go from a dealership I was working at the time, back in 2009, because the automotive industry was in such turmoil. The dealership I was working for was letting a lot of people go, and it was just a bad time to be in the auto business. And these kind of booms and busts happen in the automotive business. It was just exacerbated by the global recession that was occurring at the time, which is probably once in a generation type event. So I don't anticipate that kind of stuff happening again in the next 20 or 30 years. I mean, you're going to have the normal cycles, but something like that was pretty extreme. Nonetheless, auto manufacturers, it's a very capital intensive model. You're looking at very low margins. Brand power and loyalty isn't what it used to be. They typically carry a lot of debt. Overall, I just don't find the companies from a dividend growth perspective, I don't find them very appealing. Magna, on the other hand, as we'll kind of go over in the article, I do think that they're kind of an exception to the rule in the auto business. And one of the things I like about them is how diversified they are. Instead of relying on one manufacturer, like if you were invested in Volkswagen a few years ago before that whole diesel thing hit, that hurt. I mean, that was a real big problem for Volkswagen. I mean, they're going to have to spend, and they're spending a ton of money on fixing that issue where, they you know they obviously didn't do the right thing. And I'm not going to get into that, but by investing in Magna, because Volkswagen is just one of their many customers, you're not really going to experience that specifically or directly. Magna isn't going to have an issue disproportionate relative to all of its other customers. In fact, Magna, if you look at their sales distribution or their diversification, just over half of their sales occur in North America. So you're talking about the big manufacturers here like Ford and GM and stuff, and then the other half is the rest of the world. So they're diversified not just in terms of product offerings, but also in terms of geography. I mean, their operations span almost 30 different countries, and then they're exposed to pretty much every major OEM out there. So if Ford has some issues, some major recall or something, Magna's probably really not going to have a big problem with that. They're still going to manufacture those car parts and everything else. So, and one other thing I really like about Magna relative to the idea of investing in an auto manufacturer directly, one of the OEMs, is that they have a corporate constitution, as I talk about in the article, that entitles shareholders of common stock to dividends that amount to at least 10% of Magna's after-tax profits for that financial year. And just so you don't think I made that up out of the thin blue air here, I actually pulled it up. If you pull up Magna's investor relations and you get in their dividends and interest, you can see their corporate constitution right here. It entitles holders of common stock to dividends which in aggregate in respect of a financial year shall be equal to at least 10% of our after-tax profits as defined in our corporate constitution for that financial year. And they talk about on average over two immediately preceding financial years, it should be equal to at least 20% of our after-tax profits. So they're saying in any one year, they're going to give you at least 10%. So unless Magna takes a loss, you're guaranteed something. You're guaranteed a dividend. And Magna tends to be pretty conservative with that, which I actually kind of like. I think it's a good thing in a cyclical industry to be conservative with your dividend because, you never know when things are going to take a dip. But you're guaranteed that, you've got some downside protection. You've got kind of a floor to that dividend, which I quite like. And that's something you don't find. Ford's not going to come out and say, we guarantee our shareholders a dividend, In fact, I don't really see that in any industry. I don't know if I've ever run into that with a company where they guarantee their shareholders a dividend like Magna does. So I think that's really interesting. I think the diversification is really great if you're talking about the auto industry and manufacturing and everything else like that. And again, Magna did take a loss. I pulled up Morningstar here, and I talk about that in the reference video. Why I use Morningstar for a lot of these articles as kind of an aggregator of data. But you can see they took a loss in 2009 here, which caused that dividend to drop. So I think they suspended it for a little bit there during the Great Recession. So it's not a guarantee of a dividend, but it certainly is a floor, and you can see they bounced right back. I mean, a lot of OEMs had problems lingering for a couple of years after the Great Recession. Meanwhile, Magna bounced right back because of the strength of the business model. They took a loss here, then boom, 2010 they were earning $2 a share, and it's been off to the races ever since. So, I think it's a good business model. I mean, if you're talking about the auto industry, it's not a stock I'd want. I'd make like a core holding. It's not a Johnson & Johnson. It's not a Pepsi. It's not something like that where you've got decades and decades of dividend growth, but certainly for its industry, I think it's, if not the best option, definitely one of the best options out there. And then speaking of the dividend, we've got 7 consecutive years of dividend growth here for Magna. And whenever I'm writing these articles and whenever I talk about dividend increases and some of the dividend metrics, I use David Fish's Dividend Champions, Contenders, and Challengers list, which you can pull up under the Dividend Growth Investing tab for Daily Trade Alert. You can pull it up at the bottom here, David Fish's list right here. And on his list, he has information on 819 stocks, U.S. listed stocks that have increased dividends each year for at least the past 5 years. So, these are basically just what David's doing is he's kind of calling all of the thousands of publicly traded stocks out there into a list of just those that are increasing their dividends for at least the last 5 consecutive years, which is an incredible resource. I mean, I hope, I secretly hope that David Fish is like, immortal or something and can continue doing this for, another 80 years, because it's just such an amazing resource for the community at large, investing community in general, but specifically for dividend growth investors. And it's just, it's fantastic. But for Magna, you can see he's got all the information plugged in here in the spreadsheet. They've got 7 consecutive years of dividend growth. And in the article, I talk about the 5-year dividend growth rate because they haven't grown it for 10. So I don't really use the 10-year dividend growth rate for that because that doesn't include that dip in the dividend due to the loss they took in 2009. But the 5-year dividend growth rate is 14.9%. And you can see that right here. 14.9% under the 5-year dividend growth rate. And you can see there was some acceleration in the 3-year, and they've kind of slowed back down again most recently. Still growing the dividend at double digits. Most recent increase was 10%, which is, still fantastic, still well in excess of inflation. And, any stock's long-term total return it should be approximately the sum of its yield and growth. And if you're talking about dividend growth at 10% and a yield of over 2, I mean, you're looking at very solid long-term total return, double-digit stuff. So very attractive. So you've got 7 consecutive years, 5-year dividend growth rate, and then the payout ratio, 20.1%. That's very easy to figure out. I use Google Finance for all my pulling up all my stocks, and their quarterly dividend is 27.5 cents times 4 is $1.10, and then you divide that by 5.47, which is their EPS right here, which is trailing 12 months TTM. So their payout ratio is 20.1%. And you can see I got that right here, 20.1%, guys. So payout ratio, keep in mind that I'm guilty of this. I think almost everybody out there who writes articles about stocks is guilty, but we all use earnings per share for payout ratio. So we're dividing the dividend by the earnings per share over the last 12 months. The true technical payout ratio is actually out of cash flow because a dividend is paid in cash from cash. But earnings per share, it tends to be a pretty good proxy for cash flow. If averaged out over a long period of time. If you look at any company, look at its cash flow and its earnings per share, they're going to fluctuate, they're going to be different, but over the long haul, they're going to be roughly similar. So, most companies I look at, unless it's super cyclical and you're looking at a very off year where there's a lot of adjustments or something to earnings per share, generally it's somewhat similar, and you can kind of normalize that. If you take out some of the adjustments and normalize it, it's going to be pretty close to cash flow. Nonetheless, very low payout ratio here, 20%, which going back to that corporate constitution, 20% over the last couple of years, they're at 20% this most recent year. They're very conservative with the payout ratio, which again I think is a good thing for a company that this isn't selling beverages, this isn't selling razor blades or something where the business model is very, very secular, it's cyclical. And so with that, you don't know when the earnings per share is going to take a dip. You want to be conservative with that payout ratio so you don't have to cut the dividend. So we're looking at that. And then the yield is the last thing I'm talking about here, which is 2.49% in the article. It's 2.44 now, a little different, it's basically the same. So we got a yield near 2.5% on this stock. And when I look at the yield, and one thing I note in the article is anytime I'm looking at the yield, I want to kind of look at the yield through the lens of what investors have usually accepted on a stock over the last 5 years. So if a stock is usually yielding 3% and all of a sudden it's yielding 4 today, that 100 basis point difference, that clues me into something's going on there. Probably undervaluation, or maybe the stock just recently increased a dividend dramatically and the price hasn't caught up yet. Something is happening though when you've got that major disconnect. And you can see here the 5-year average for Magna. Under the valuation tab for Morningstar, the 5-year average yield is 1.9%, and it's currently at about 2.5. So we've got a difference of about 60 basis points, which I talk about right here, 60 basis points higher than the stock's own 5-year average. So that means that investors over the last 5 years have, on average, accepted a yield from this stock when they bought it at 1.9%. And investors today are collecting yield of 2.5. So right away, you're kind of ahead of the race. You kind of get a head start there on collecting income from Magna because you're getting a yield that much higher than what you typically would have had over the last 5 years. And you can kind of see that pull up in the 5-year chart here. Magna spent a good chunk of time here, well into the 50s. And meanwhile, the company has made more money, has become more profitable. The dividend is now higher, and yet the stock is lower. So investors were paying more for a company making less and paying less in a dividend before than they are now, which is silly, right? And that's why the stock market provides opportunity sometime, which I think Magna could be a pretty good example of that. So that's what's going on with the dividend. And then the next thing we get into with these articles, we obviously get into growth. We talk about, or I talk about 10-year growth for top line and bottom line growth. So I'm looking at revenue growth over the last 10 years and then earnings per share growth over the last 10 years. And I talk about why I use 10 years in the reference video, which you can pull up and kind of go through that. Magna's revenue, they've increased it from a little over 26 billion in fiscal year 2007 right here to about 36.5 billion in fiscal year 2016. And I'll show you where I got those numbers from in the annual report here. This is their most recent annual report. And you can see revenue right here, 36.445 billion. 36.445 billion. And then I had to pull up an older annual report here, which is right here. Whoop. I was already on the right page. So we're just over 26 billion, right? 26,067. And you got 26,067. So I've got the two annual reports, and this is 10 years worth of information. It goes from 2007 to 2016. And I already did the math here, compound annual growth rate of just under 3.8%. Just to kind of show you that, where I'm getting that from. So I've got 26,067 right there, and I've got 36,445. So you've got a compound annual growth rate of 3.8%, right? 3.79%, which, for a mature company like Magna, that's not a bad growth rate. I like to see mid-single digits, pretty close to that for mature companies in terms of revenue growth. Somewhere between 4 and 6%. They're right in there. And earnings per share, we can see went from 147 to 516, and I'll kind of show you that again. So we've got earnings per share, 516 right here, diluted earnings per share, 516. And then the older annual report, we've got diluted earnings per share of 586. So you might kind of wonder what happened here because we've got a higher number, 586, than the newer number, and certainly what I came up with, which was $1.47. Well, again, in the reference video, I talk about, you got to make sure that you're looking out for stock splits, and Google Finance usually pulls it up for you real quick. And you can see a stock split here in 2010, 2 for 1, and a stock split here, 2 for 1 in 2015. So they did 2 stock splits, two for 1 stock splits. You obviously have to adjust that 586 for the 2 stock splits. So, times a quarter, which is $1.47, basically rounded up. And you can see $1.47 right there. So you see where the numbers come from here, right, guys? So $1.47 to $516. And we've got 9 compounding periods because the first year isn't a compounding period, it's a starting point. So we've got compound annual growth rate of 15% over the last 10 years, which is like, wow, right? Outstanding growth for Magna over the last 10 years, which includes the Great Recession. So had they not taken that dip, who knows what they would have done. It's incredible, very impressive. And obviously we want to kind of see what happened here. Why is revenue only growing at 4%? Earnings per share growth is growing at 15. It's a pretty big disconnect here, right? Well, I talk about that in the article. Anytime I've got a major difference in top line and bottom line growth, I try to kind of look at the numbers and tell you readers where I think that's coming from. And for Magna, it's 2 different reasons. Number one, they bought back a lot of stock over the last 10 years. Which we can pull up, Morningstar. You can, in the annual reports, it'll show you too. Same thing. But just kind of a quick look at it here. We've got 456 million shares here in 07, right? And the most recent fiscal year, we've got 393 million shares, right? So they reduced their outstanding share count by about 14% over the last decade, which is strong. I mean, it's not the highest I've seen, but it's still pretty good. I mean, again, considering the Great Recession occurred in there, and they're an auto manufacturer, and this is, we're in cycles. I mean, granted, we could be near the top of a cycle. A lot of, articles and a lot of talking heads try to indicate that we're near a top of a cycle. I have no idea where we're at in terms of that, but I do know that over a longer period of time, and when you kind of stretch the window out here, Magna's doing pretty well. But they reduced their share count down by about 14%. And the other aspect of that I talk about in the article, and I'll kind of pull it up again here. I talk about margin expansion and share buybacks, right? And you can see the margin expansion occur right here. Net margin over the prior 5-year period, not good for the industry, not bad. They obviously had that anomaly in 09 due to the loss but it's okay. But then you look at the most recent 5-year period here, right? Wow, what a difference. I mean, we're averaging in the high fives or something, right? So definitely some margin expansion, which, is, give credit to Magna. They're obviously more efficient with the business, and, possibly getting higher prices for their business. And, they're just doing a better job across the board. I mean, that doesn't happen magically. So, the last couple of years especially, really, really strong margins here for what is essentially kind of a middleman type business, if you will. They're a supplier. They're doing really well. So, kudos to them for that. And I talk about, the difference, why they increased profit growth so much. Now, that said, are margins going to expand like that continuously? No. Can they expand much more than they already have? I don't think so. I mean, I think they're probably nearing a top right here. I mean, that's getting up in the sixes for this kind of business. I mean, Google Finance will usually pull up, a number of different competitors, and you can kind of get an idea in terms of profit margin, where some of these other businesses are at. And, Magna's up there. I don't really think they're going to be able to do a whole lot more with that. But nonetheless, they're operating at a very high level. And yet, as we'll talk about later, I think the valuation is very low. So they're doing very well right now, yet the valuation is lower than it was when they weren't doing as well. So it doesn't make sense, which is why I wrote about the stock and why we're doing the video today, right? So again, that's why you see that kind of that faster bottom line growth. And then, the reason why we look at growth, and as I talk about in the reference video, we want to try to figure out, any business is worth the sum of all its cash flow. From now until infinity, discounted back to today, with net present value. So any company is just worth all the money it can possibly generate over its lifetime. That's what a company's worth, and then discounted back to today to account for the time value of money. So, and when I do analysis, when I value a stock, I use a dividend discount model analysis, which all it's doing is substituting dividends for cash flow. So all I'm saying is that any stock to me is ultimately worth the sum of all its dividend income from now until the end of time, until infinity. Again, discounted back to today. So that's all I'm saying there. And in order for me to kind of estimate or form a baseline for future expectation for dividend growth and kind of take that number out, over a long period of time, you have to get some kind of, you have to see where the company is growing at now, where it's been, where it is, and where it might be going in the future. And you kind of mesh all those numbers together to come up with an expectation, right? So I already took a look at where they've been at over the last 10 years. And then I also want to look at where I think they'll be over the next few years. And for that, I use S&P Capital IQ. They have professional analysts that go in and take a look at company guidance, and they go in and take a look at industry trends, and they kind of, take all that information and kind of blend it together, and they come up with a 3-year estimate for earnings per share compound annual growth. And I have that in the article at 17%, and I'll show you where that came from right here. So 3-year projected EPS compound annual growth rate, 17%. And they get into the rationale and stuff down here, which I talk a little bit about in the article. 17%, that's an acceleration off of what was already very impressive growth. I think that's aggressive. But even if Magna were to do half that growth, or if they were to come in at 10% over the next 3 years, which would be way less than 17, that's still very, very strong growth. And with that low payout ratio of 20%, I mean, that leaves plenty of room for very, very, very excellent dividend growth, certainly well in excess of inflation and probably into the double digits. So they don't really need to do 17% growth for me to be a happy investor, but that is what I have in the article. That is what S&P Capital IQ is anticipating. We'll see. I don't think it's going to be that high, but it doesn't have to be. So that's what we're getting into. So we've got kind of the picture of growth. We've got a company that's growing its bottom line into the double digits. They're expected to continue growing well into the double digits. Not much more you could possibly want from a company. I mean, you've got a very diversified business here, exposed to pretty much every profitable country and company in its industry in the world. There's just not much to dislike really, other than maybe the industry itself being kind of cyclical. The next thing I get into is the balance sheet. We've got the long-term debt to equity ratio at 0.25 and the interest coverage ratio of over 32, which is outstanding. I mean, just an outstanding balance sheet. And that's another reason why I prefer Magna to a company like, a Ford or something like that, or a General Motors, because those companies typically have, stretched balance sheets because, it's a very capital intensive business to, build these factories and ramp up production. And, every few years they got to change molds and build brand new cars and Magna doesn't have to worry about that stuff. They just, one of these companies call over and they talk about what they need, and Magna produces the part. I mean, it's very simple for Magna, but for Ford and all these other companies, I mean, they got to constantly keep that brand loyalty. They got to constantly keep customers excited about their product. So you're talking about a lot of money to do that. So you've got balance sheets that look a lot different. For Magna, their balance sheet's outstanding. And again, as I talk about in the reference video, I consider the interest coverage ratio a more important number than the long-term debt to equity ratio in terms of a bench, in terms of a bellwether mark or whatever, or some type of benchmark for balance sheets. That's the number I look at. And just to show you where I got it from, you can kind of see here. I'll first pull up long-term debt to equity. You can see long-term debt 2.4 billion, which is really nothing for this company. And you've got shareholder equity down here, 9768. So 0.25, right? Just round it up for you guys. It's basically the same thing. But long-term debt, it's 2.4 billion. We've got a market cap of over 17 billion. I mean, this is a pretty large company in its industry, and they have very little debt. And the balance sheet hasn't really deteriorated over the last decade, which a lot of companies have taken on a lot of debt over the last 10 years. Magna's actually in really good shape. So with rising interest rates, affecting some of those balance sheets with a lot of companies, Magna maybe doesn't have to worry about that quite as much. And then the interest coverage ratio, you can see where I got the 32 mark there. We're just going to pull up, EBIT and interest expense. And then of course EBIT, you just need to take income before income taxes and add back in your interest expense, because that was already taken off of this 2780 number here. The interest expense was already reduced, so you just got to add that back in. So the 2780 plus the 88 million for the interest expense gives you 2868. So it's almost 2.9 billion in EBIT, and then you divide that by the interest expense of 88 million. So you've got 32.5, and then like I said, it's over 32. So you could even round that up and say they're at 33. But yeah, I mean, just a fantastic balance sheet. Certainly something that I wouldn't be concerned about in the least. And then another area of the fundamentals I get into. Again, keeping in mind, as I'm going through some of these numbers and everything, as I talked about in the initial video that I did, that we started the series off with, this is a quantitative look at these companies. This is a quantitative analysis, quantitative valuation look, really from a high level at that, on all these stocks. So I don't get into a lot of the subjective nature, the qualitative analysis, because each individual investor can come up with a different opinion when it comes to qualitative analysis, because it is so subjective. The numbers I'm looking at are objective. I can go onto the balance sheet. I can show you the actual numbers. We can't disagree about EBIT. We can't disagree about net margin. These are hard numbers, and I like that because I think it's more actionable for you readers to look at these numbers and say, hey, this is what it is. This is Magna. This is what the business is doing. This is its profit. This is its dividend. This is where we're coming up with this valuation. So, you can kind of hem and haw about, the qualitative analysis and say, well, Magna maybe could be more competitive here, maybe its product lineup over there. That's really up to each individual investor to decide for themselves. But, in terms of objective data, I like to kind of focus more on that, because it's something that, again, is more actionable, and certainly something where when I'm doing these videos, I can go back and show you where I came up with all this stuff. It's very easy to follow along for you readers too, and these articles stay pretty evergreen as a result of that. So over the last 5 years, we've got net margin, return on equity, and I'll show you where I got those numbers from. S&P Capital IQ kind of calls those numbers and aggregates them down here. So you've got 5-year averages, net margin 5.18%. Return on equity 19.43%, which lines up with what I've got in the article. And again, these numbers I showed you in the initial video how to get these numbers. They're very easy. Net margin and return on equity, super easy numbers to go into any annual report and grab a calculator. It takes you 2 seconds to get them. I just use S&P Capital IQ because I've written hundreds of articles on stocks now, and I've found them to be accurate almost 100% of the time. So instead of me going through 5 different annual reports and coming up with the numbers and averaging them out every single time, S&P Capital IQ does it for you. It's very easy to pull these up, and then that's what I use in the articles. But in the initial video, I kind of did the hand, the math by hand, if you will, and pulled up a calculator and showed you all that. They're very easy. It's very easy to get these numbers. So again, I talked about the fundamentals at the bottom here. They're excellent. I mean, great balance sheet, excellent profitability for its industry. Net margin of over 5% over the last 5 years, which is actually accelerated or expanded from the prior 5-year period, which already was pretty good. Now it's great. Return on equity, keeping in mind that the balance sheet is very healthy. That's great. ROE of near 20% on a business that isn't really leveraged too badly. And excellent growth. You got double-digit growth in terms of the dividend, in terms of earnings per share, and then they're expected to continue that over the next few years. So, there's really nothing to dislike here. You can't say, oh well, I don't want a business that's growing at 15% annually. Well, then, you don't want to be in stocks. You know what I mean? So, there's really nothing you can kind of complain about here with Magna. It's a really well-run business. Um, and one other thing I wanted to mention here before we get into the valuation, the dividend, something I didn't mention in the article, and I don't really get into taxes because everybody's tax situation is different, but Magna is a Canadian company. They're based out of Canada. Although they declare and pay their dividends in dollars, if that dividend hits your brokerage account and you have a taxable brokerage account, you're going to see that Canadian dividend tax withholding come out, which is 15%. Now, generally at tax time, what I do is I get a dollar for dollar credit on all that at tax time. So I never really lose the money. It's just kind of temporarily taken away from me and then given back at tax time. If you hold the stock in a tax advantage account like an IRA or retirement account, then because of the tax treaty we have with them, you won't see that 15% come out. So if you prefer to hold this stock in a retirement account and not have that 15% reduced, or depending on how you hold your investments, retirement accounts or taxable accounts or whatever, it's just something to consider. I've never used tax advantage accounts because I knew that I wanted to kind of be in a position to retire as early as possible in life. I wanted to be financially independent in my early 30s, and I knew that I wanted to be able to access my dividend income ASAP in life. And so I knew that I wasn't going to be working a traditional job for too long. So I never took advantage of like a 401k or an IRA or anything like that. And I have no regrets over that. But just keeping that in mind, that Magna, if you hold it in a taxable account, you'll have that 15% withheld, and then at tax time you'll have to get that dollar for dollar tax credit. So getting into the valuation now, you can see the PE ratio I have in the article, 8.07. I mean, a PE ratio of 8. If you have ever read Ben Graham's illustrious book on stock investing and analysis, and how to become this an amazing long-term investor. The book is called The Intelligent Investor, and it's a book that Warren Buffett talks about almost at any opportunity or any chance he gets as being kind of the greatest book on investing ever written. Ben Graham taught Warren Buffett. So if you think Warren Buffett is great and he's my hero, but if you think the world of Warren Buffett, imagine the guy who taught Warren Buffett, and that's who Ben Graham is. And he wrote a book. He wrote actually a couple of books, but he wrote The Intelligent Investor. And in the book, he talks about what a stock should be valued at if it's not growing at all. Like, just assume that the company never grows again. I think he put a PE ratio of, if I remember correctly, 7.5. And now that was a number of years ago, and interest rates were different and everything else. But if anything, with interest rates being so low, stocks should be worth more. And the PE ratio on Magna is 8. So it's almost priced as if the business isn't going to grow at all anymore. And I understand that it's a cyclical business, and earnings per share, maybe they are peaking right now. And so if they drop, obviously with the earnings portion of the PE ratio being lower, then that increases the PE ratio, assuming the price doesn't change. Still, that PE ratio is very, very low for a high quality business, even in a cyclical industry like this. And if we look back at the last 5 years, just kind of seeing what investors were typically paying for Magna, they've paid a PE ratio of 10.8 on average over the last 5 years. So Magna was making less money 5 years ago, was, paying out a smaller dividend, wasn't the company it is today, and yet investors were paying a higher PE ratio. Does that make sense to you? I don't know. Again, if the EPS gets cut in half and and the price stays the same, then that PE ratio doubles, right? Goes up to about 16 or so. Still, the industry average is near 16. So, unless Magna's gonna, take a massive hit to earnings in the very, very near future, this seems like a pretty cheap stock to me. Then you can kind of see all of the other, basic metrics: price to book, price to sales, price to cash flow. If you look at price to cash flow, 3-year average is 7.8. Currently, it's 5. So, and then as we talked about the yield earlier, the yield 60 basis points higher than what it has been on average over the last 5 years. So all in all, this just paints a picture of undervaluation relative to the industry, relative to the market, and certainly relative to the stock's own 5-year average. There's really no metric that says this stock might be overvalued. There's just nothing that would indicate that at all, at least not that I can see. And I talk about that being below the industry, being below the stock's own 5-year average, and being below the broader market. And the yield, that's quite a bit higher than what it typically has been as well. And then again, as I talked about earlier, and as I talked about in the reference video, I use a dividend discount model analysis. With this stock, I use a 10% discount rate because it's not a particularly high yield. If this stock were yielding, 4% or higher or 5% or higher, I would back that discount rate down a little bit, because all else equal, a higher yield's worth more to me. But with the yield being 2.5%, 10% discount rate I think is appropriate. And then I use a dividend growth rate of 8% long term. And that is on the higher end of what I normally would account for. But I think, if you look at the payout ratio of 20%, you look at the dividend growth rate, over the last 5 years, 15%. You look at the earnings per share growth over the last 10 years, 15%. You look at the 3-year projected earnings per share compound annual growth rate, 17%. I don't think 8% is really being that aggressive, really, if you average it out over the long haul. Maybe Magna can grow to 12, 14% over the next, 5 or 10 years, and then it slows down to 7 or 8 or something like that. But over the long haul, I think 8% is a pretty reasonable expectation, averaged out for Magna. Again, it's on the higher end of what I normally account for, but Magna's payout ratio is very low. Their growth rate is very high. It is a cyclical industry. But then on top of that, you've got that corporate constitution kind of providing a floor to the dividend. So unless they take a loss, you're collecting something from Magna. So, and then using that calculator I talked about in the initial video, I've got the annual dividend here at 110, basically just, I'm exchanging dividends for cash flow. And I've got that 8% growth rate here, 10% discount rate. And then you can see the 59.40 down here is the fair value, the intrinsic value, the estimated intrinsic value for the stock. And you've got that right here, 59.40. So I talk about why I use a dividend discount model analysis in here, and then I compare my number to that of what Morningstar and S&P Capital IQ come up with, which I think adds weight to, because my analysis is just, it's just one look at a stock. It's just one investor's viewpoint. But in order to provide you readers even extra value and extra perspective, and again, to add weight to that conclusion, I want you to see where other, these are professional analysts that, are paid money to all day long analyze, a certain number of stocks. Usually they have like an analyst, like they have a few analysts per industry, and that analyst just concentrates on a small basket of stocks all day long. So, that would theoretically provide them extra opportunities to know a little bit more about a particular company and stock than say it would for me, because I'm not going around and interviewing Magna executives and touring facilities and things like that. And analysts have access to a little more information than I might. So I like to throw these in, and that way it kind of says, hey, maybe I'm way off. I don't know. So let's see what they come up with. Morningstar rates their stocks from a 1 to 5 star rating, and they give them 4 out of 5 stars on the valuation. And then I pulled up their fair value estimate, which is 55 right here on their analysis. And then you can see right here, 55 bucks, 4-star stock. So not far off from what I came up with. I came up with almost $60 per share. They came up with 55. So we're in the same ballpark. And then S&P Capital IQ ranks their stocks similarly on a 1 to 5 star scale. They rate Magna a 5-star strong buy, and they give the fair value calculation as 55.20. That's what they estimate the intrinsic value for Magna to be, which is right here. And I wrote this article a couple weeks ago. It looks like S&P Capital IQ came in and they actually increased that fair value a little bit since the last time I pulled up their analysis. So if anything, it just gives this article extra weight and just tell you, it just says maybe the stock's worth even more than what I came up with. Nonetheless, you can kind of see where that's at, and then you can see the star rating up here, 5-star strong buy. So what S&P Capital IQ is saying this stock, in their opinion, is dramatically undervalued and looks like an excellent long-term investment at its current price. And then I average these 3 numbers out to come up with kind of a final valuation that we can base our conclusion off of. So I take my 59.40, I add in Morningstar's 55, I add in S&P Capital IQ's 55.20. I divide that by 3, which gives us a total, the final average valuation at 56.53, which is right here. And that indicates the stock is 28% undervalued. It's almost 30% undervalued, which is, pretty significant. There's not They're, I write these articles all the time. I constantly am on the prowl for good investments, and there aren't many out there where I could tell you just off the top of my head that, hey, I think the stock looks to be about 30% undervalued right now. Magna would be one of the few out there that looks like that, with this kind of, quality, good balance sheet, very strong growth, the dividend metrics, that corporate constitution with that dividend kind of, guarantee, if we can call it that, lot to like. So it's 30% undervalued, all in. It looks like an appealing investment here. I don't think there's really a lot to dislike, across the board. They're diversified across OEMs, across geographies, across different components. They could almost manufacture a car by themselves. The stock looks undervalued. The dividend metrics are there. And one other thing I want to just quickly mention here before I let you guys go. One reader actually was asking about the rise of EVs, hybrid cars and electric vehicles and things like that, and how that might impact Magna. And I wanted to just kind of pull up their customer list for you guys real quick, because he said, well, what if Tesla starts selling more cars? Is Magna going to be hurt by that? Tesla's actually one of their customers. You can see right here. Magna's customers, Tesla's one of them. So, and all these other manufacturers are obviously a lot of them are already manufacturing their own EVs and hybrids and stuff like that. So, and car parts are car parts, guys. I mean, body panel or whatever it might be that you install in a car, they work the same on EVs as they do in the other car. I mean, there might just be less actual moving parts and things like that, especially mechanical on an EV. But otherwise, I mean, they still require a lot of parts. And as these EVs rise and as these EVs become more if they start to proliferate more than they currently already do, these parts are even more expensive and more specialized, requiring companies like Magna even more than ever. So I don't really anticipate that being much of a problem, but I just wanted to kind of point that out, that the reader was worried about Tesla, and I'm not particularly concerned about Tesla. I mean, they're kind of a stock that CNBC likes to talk about a lot, but they're really not selling a lot of products. So I don't know what's going to happen to the company. It's really not in my wheelhouse, but I did want to point out that they are a customer, one of Magna's customers. So that's it, guys. I want to just kind of go over Magna for you. And again, keeping in mind that this is the first video in this series where we're going to kind of go over one of the Undervalued Dividend Growth Stock of the Week articles from the prior month and kind of point everything out. And just kind of keeping in mind, when you pull up the Undervalued Dividend Growth Stock of the Week articles, when you pull up the archive here, this was May's article. So in May, I wrote about Amgen, Qualcomm, Magna, and I also wrote about Discover Financial. It just hasn't been archived yet. But each month, I'm going to take one of those 4 or 5 articles, and I'm going to do a video on it and kind of show you where I came up with everything, talk about the stock, and kind of provide a more tangible feel for the analysis, if you will. And kind of put my voice to something, lend my voice to it, and I think provide, even more value. So in June, there'll be another 4 articles, another 4 Undervalued Dividend Growth Stock of the Week articles, and I'll take one of those stocks and do another video on it and show you where I came up with everything, and start pulling some financial statements and everything else. So hope you guys enjoyed. I enjoyed. Hope provided value for you. Thank you so much for taking the time to watch today. Bye-bye.